When markets are volatile, it's very natural to be worried about the impact that it might be having on your portfolio. And when you're worried, you might want to take action. However, it should also be noted that sometimes doing nothing might actually be your best course of action. Because if you have a sound investment plan, you're probably already in a good position to weather these market storms. However, we understand that it might still be upsetting or painful to watch the value of your portfolio decline over time. To assist you in understanding market volatility and how to preserve your portfolio during these times, we've put together 5 strategies for dealing with difficult markets. Take a long-term view. Any sharp decline in the market often comes with headline news like crisis or meltdown. And while that certainly creates a sense of urgency, it should be noted that volatility really is a normal part of investing. Even though market volatility is not uncommon, it can certainly be unsettling. Remember that market declines have traditionally been followed by market recoveries. Statistics have shown that in the past, markets have gone on to retrace their losses and even gone on to post new highs. So in other words, market cycles like this are normal and the general trend is still to move upwards. In fact, the S&P TSX Composite Index has gone on to return 10.2% on average per year over the last 45 years for the years ending December 31, 2021. Now, to reach that number, though, investors did have to go through many peaks and valleys. One defense against market volatility is to put a long-term perspective on daily news. Despite the crisis reporting, we know that recessions end, businesses continue to operate, and markets and economies continue to grow and recover. Be diversified. Diversification is a key principle in investing. Diversification refers to the process of spreading out your investments across different asset classes like stocks, bonds, or cash, and can be subdivided to talk about different country exposure and also to different styles of investing and small cap versus large cap stocks. Why is diversification important? Each asset class will respond somewhat differently depending on the economic conditions, and we can't always predict which asset class is going to do the best. However, what we do know is a well-diversified portfolio has an appropriate allocation to each asset class depending on market conditions, and we can see from the chart that a balanced portfolio or a well-diversified portfolio has smoother and less volatile returns than any portfolio that is overexposed to any one particular asset class. The process of determining the right asset mix is called strategic asset allocation. For example, most portfolios will have a mix of stocks and bonds. Bonds generally provide a little bit more downside protection, might not provide large upside potential, and stocks or equities are the ones that generally provide more upside potential but may take on more risk. The goal of strategic asset allocation is really to find a portfolio whose return objectives match a particular risk tolerance for you. Risk tolerance will be based on things like your time horizon and your willingness to accept different levels of risk. If your current portfolio mix does not match your investment objectives or is not properly diversified, then it's probably time to review your strategic asset allocation. However, if you've already gone through the exercise of creating a strategic asset allocation, then you probably shouldn't be changing it just because the markets are volatile. Instead, I would urge you to consider maybe changing it if, for example, your investment goals had changed. Also keep in mind that any strategic asset allocation that an investment advisor came up with you has already taken into consideration the potential volatility that may arise from having a portfolio like that, as we do take into consideration historical returns. Major changes to your strategic asset allocation during times of market volatility might actually hinder your long-term performance when working towards a particular goal. Resist the temptation of market timing. The perfect strategy would be to always sell when things are at the top or the market's peaked, and then to buy back in when the market has bottomed. However, knowing the exact timing of this can be very tricky and in fact is nearly impossible. While investors know that they should be selling when things are high and buying when they're low, that's actually the opposite of what a lot of individual investors will actually do. As things start to fall, it's natural to want to sell out of your investments, and then of course when things start going back up, it's natural to want to sort of get in on that and to buy back into the market. So what usually winds up happening is we wind up selling and then buying in at a higher price if we don't stick to our strategic asset allocation. Furthermore, when the market does start to recover, it often happens in bursts. And so missing out on one or a few days of the best performing days of the market can cost you huge amounts of money in the long term. Take advantage of market volatility. Given the market's long-term rising trend, it makes sense that market volatility or downturns like this provide an opportunity for long-term investors to buy into the market more. In other words, things are on sale. And it's really the rationale behind Warren Buffett's saying, "Be fearful when others are greedy, and greedy when others are fearful." However, of course, we don't all have $1 billion floating around to just be able to put into the market on any given day. However, we can still take advantage of these down days, such as using strategies like rebalancing the portfolio or using dollar cost averaging to buy back into the market over time. In general, rebalancing tends to make sure that you stick to your risk profile over time and helps with the idea of selling high and buying low. Invest with an advisor. Research shows that Canadians that work with an advisor acquire more assets, and of course, the longer they work with an advisor, the more their wealth grows over time. A financial advisor will help you in determining your financial goals and create an investment plan that includes an appropriate strategic asset allocation. Financial advisors will help you in determining where you are now and where you want to be, and specifically if any gaps or obstacles fall in the way. What's right for you? There is no strategy that can fully insulate you from a market decline. Nevertheless, we have been through severe market volatility before, and the strategies presented here today have proven to add value and still allow investors to prosper over the long term. If you're at all concerned about the impact that market volatility has had on your portfolio, our team at Ferguson Financial Planning is pleased to meet with you, and you can schedule a consultation using the link in our bio. Additionally, check out our articles, and we regularly update our website with market commentaries and strategies like this. Please be sure to like, subscribe, or leave a comment if you found these strategies useful. Thank you for watching.